One point that I would make is that when you say this is the highest inflation since 1982, 40 years basically, that's true. But the inflation in 1982 that we're comparing it to was the end of the inflation. It started really in a severe form around 1976. And so by 1982, it had come down to 7.5% or thereabouts. So you're right about those numbers, but it was up to 15% in 1980. So 7.9 or whatever the last number was in terms of the monthly inflation figures, yeah, that's pretty bad. But don't think it can't go a lot higher. It can. What I expected, and I still expect this. Let me put it this way: I still expect this, but I pushed out the time horizon because a lot has happened and we have more data. There are two kinds of inflation. And one is what they call cost push inflation. The other one is demand pull inflation. Those are economic jargon. But demand pull is when it's driven by the consumers, the everyday American or everyday person around the world. They see some inflation. They go ask the boss for a raise. They go, hey, I need more money to keep up. They accelerate purchases, like, oh, gee, if that refrigerator is going to be more expensive 3 months from now, maybe I better buy it today before the price goes up. It kind of feeds on itself, but it's very much driven by consumer behavior, the behavior of labor and working people, trying to keep ahead of something that they're living through. So that's demand pull. The other kind of inflation is called cost push. That comes from the supply side. That basically is, an oil embargo or a war in Ukraine or economic sanctions or supply chain disruption. There could be a lot of causes or multiple causes, but basically it's not that the consumer has so much changed his or her perspective, but they can't get stuff, or the suppliers are raising the prices because, hey, our input prices are higher, so we have to raise the prices to consumers. Now you can have both. One can feed. It can start as sort of cost push, meaning it starts with supply chain disruption, comes from the supply side, but then the consumers say, "Hey, no mas, enough. I want to raise," and so it can feed on itself. The reason I make that distinction is because the Fed can possibly do something about the demand side. The Fed can, squash it by raising interest rates and raising mortgage rates and deflating asset values, et cetera. The Fed can't do anything about oil. The Fed can't do anything about the supply side. They maybe people think they can, but they can't. And that was what we saw. That was how it started in the 1970s. It started with the Arab Oil Embargo, which went through two separate phases. One with the Arab-Israeli War, and then later with Iran. We had two separate, periods of spiking gas prices and gas lines in 1974, again in 1979. But that started from a supply side that the Fed couldn't do anything about, although the Fed probably was too easy at the start of it. So right now, this inflation has come from the supply side. Now, how will it play out on the demand side? That's the question.
That's interesting, because I had one professor of applied economics on saying, look, this inflation has nothing to do with broken supply chains, etc. It solely has to do with money supply and the surplus of it. So would you say not so to that?
Was that Professor Hankey or?
Yes.
Yeah, I know Steve. I have two degrees from Johns Hopkins, so he's very much Steve is brilliant, great on foreign currency, great on currency boards, and a lot of other things. I completely disagree with that description, and I'll tell you why. And I've said this before. The Fed has exploded the money supply, so there's no question about that. M0 has gone up by 400%. The Fed's trying to rein it in a little bit, but when you go from 800 billion in 2008 to 4.3 trillion in 2013 when they started the taper, to 7 or 8 trillion, which is where it was after the pandemic in the spring of 2020, there's no question about the money printing. But that money doesn't go anywhere. It doesn't do anything. It's basically the Fed expands M0 by buying bonds from the banks. They take the bonds on the portfolio. They give the money to the banks. Money comes out of thin air, but the banks just give it back to the Fed as a deposit in the form of excess reserves. So you're inflating the liability side, which are the excess reserves, and the asset side, which are the bonds. You've inflated your balance sheet, you've increased M0, but you haven't done one thing for the economy. There's nothing about what I just described that goes into the real economy. Now, where does money for the real economy come from? It comes from commercial banks lending and consumers spending, and that shows up in velocity. And if you look at the velocity statistics, they've crashed in the last 10 years and they're still going down. So the reason so-called money printing doesn't turn into inflation is because the money doesn't go anywhere.